Tim Quast, good morning, sir. How was your weekend?
Good to see you. It was awesome up here in the mountains. And apparently Joel must have had a good weekend because he's wearing a tie.
Oh, I know. He's
It's
all fancy now. We're all wearing suits now, apparently, Tim. I don't know if you heard.
Right?
I like this tie.
Yeah, for those of you who came
Did
in
not
late,
get that memo.
for those of you who came in late and missed the news, Jason was on CNBC this morning. Behringer Capital has acquired a majority stake in Benzinga.
Wow.
That news was on.
So they're turning us into suits, Joel thinks.
So
I'm still going with the t-shirt look, so I'm going to hold out and not get the comb as long as I possibly can. But Joel's already full suit mode.
He's thrown in with the corporate guys.
Yeah, I know. He's corporate now, yeah.
So I'll give you guys the inside scoop. What actually happened is we were going to do a SPAC, and we went to a vote, a company-wide vote.
Okay.
And nobody wanted to do it. No, I'm just kidding. That's not what happened. But if that did happen,
I didn't get a vote on this. What the heck's going on?
But if that did happen, it would have been funny.
Dude, my jaw's hitting though. I was like, I didn't get to vote.
Tim, I was going to ask Dennis this question, but I'll pose it to you as well. We were just talking about trading halts. Here's the question: when a stock is halted like that for volatility,
we're talking DWAC,
yeah, or fun or whatever.
Okay.
What controls where the stock opens out of that halt?
Supply and demand.
Yeah.
The same rules apply. It's wherever the national best bidder offer is, and the price will be determined by the fastest automated quote to get to it. That's the law. The law says that a marketable trade has to flow to the best available price, and that's why somebody like Citadel will always price the market on the open. It's the same thing. People don't realize this, that on the floor of the NYSE, it is against the laws, against the rules that the NYSE itself has established to open the market with a customer order. It will open on trades from one of the 4 DMMs, designated market makers, which are Citadel, Infinium, Virtu, and GTX, I think, right? So those are all proprietary traders. And that is who will set the bid or the offer. It'll be the offer that always takes precedence because that's, again, the rules of the market. The offer will be the highest price in the market because the offer will be higher than the bid. So that's what will set it.
It's basically just coming out when the stocks halt. You have a new auction. You're getting new little auctions all the time, and all the bids and all the offers come in. Obviously, and some are going to be marketable depending on. But like Tim says, they're going to look at where that auction clears, and that's where the opening price is going to be, and then it's going to continue to move from there. What I was arguing before you came on, Tim, is that these limit up and limit down circuit breaker does not work well for these smaller stocks. It's very disruptive to the natural trading. I get it. They put these in for people who are newer to the markets. This came in after the financial crisis because we had, they didn't want stocks trading all the way down. And after the flash crash, especially because they didn't want that was really it. I shouldn't say the financial crisis. The financial crisis maybe started some regulation. But then the flash crash of May 2010 was, May 6, 2010. I believe it was 2010. Yeah, I'm losing track of years here. Yeah. Was where they said, okay, well, we can't have stocks trading from $40 to a penny. And just instantly because there's no bids. We need to be able to stop stocks from going down too quickly. So that works well, in the event, like Microsoft should never, or, some of these stocks, Accenture, I believe, trade all the way down to a penny. That limit up, limit down would have stopped that from happening. So that was a nice Band-Aid for the problem. But the problem is when you have these smaller stocks, which are subject to the same rules, yes, the bands are wider for some of the smaller stocks, but they're obviously not wide enough. So when you have material news on a small cap company, the price can't go to where it naturally wants to go right away. And a lot of times what you see is the boom, the up, the halt. And then it wants to go in the boom, the up, another halt, because it doesn't even get to clear as high as it wants to clear. So because they put, and obviously that's all to do with market structure behind the scenes. But what is a better mechanism? I get, the intentions of, trying to protect the retail investor. But we had an example on Friday, Tim, where Funware started turning the other way. PHUN went from $1 to like $24, started turning, halted around 18 and reopened at 8. I mean, you catch so many people. The stock reopens 50% lower because everybody's like, I got to get out now at the same time. And that happens to be the low, and then it starts to bounce back. I mean, what is a better mechanism or a better solution? I'm really throwing you under the bus because I don't even know if I know what the solution is here. But I just think the disruptive, we need to come up with something different, or we need to remove the limit up, limit down circuit breakers for some of these smaller stocks.
It's very difficult. I go back to the cattle auctions of my youth. I grew up on a cattle ranch, and so we would take cattle to the auction. And if you didn't like the price that the buyers offered, you could buy your cattle back. Maybe and literally that's what you would do. You would take your cattle off the market. So maybe that's an option. Maybe if Funware doesn't like or whoever owns the stock doesn't like the price, you get to pull your bidder offer. But I don't know, Dennis. It's a very challenging feature of a continuous auction market. That's the problem. The problem is a simple problem to understand. It's that this is not the kind of auction where everybody shows up and there's a piece of art for sale and you bid for it. It is that there's a relentless train of bids to buy and offers to sell in increments of, whatever it is. You could put 25,000 shares in there, but the likelihood that you're going to match at that size is minuscule. So that's the challenge. It's a flaw in market structure, as is what drives DWAC. We could talk about that too, but I don't have a ready solution. You're right about the genesis of that. People used to put in stub quotes so that you would put in a penny. You would put in a penny to buy, because who's going to sell their stock to you for a penny? And then you'd offer to sell
it for a penny.
100,000.
Right, sell it for 100,000, or buy it for 100,000, or we'll sell it for 100,000. And so then you trade between those. Well, then everybody vanished except who had the stub quote.
Yeah, liquidity literally. There was no bids. That was a flash crash. It wasn't even a lot of selling pressure. It was the lack of liquidity. It was the fact that we had no bids in the market, no real bid. It's
Dennis, you wrote about Rambus, right? I don't know. I probably mentioned this on the show before, but in January you had that incident in Rambus.
We saw it in individual stocks where you would get this liquidity, and maybe this is a good, segue into, what Tim's talking too. I mean, we had a when we had a floor, and Joel was a market maker on the floor. I mean, you get, you had a different type of market where you had affirmative obligations, and what those are is that a market maker has to give you a reasonable price. I mean, the specialist on the NYSE floor, a lot of people thought the specialists were crooks, but you know what? They would come and at least give you a price, a reasonable price. What happens when it's all moved to, high frequency automated market making systems that don't have affirmative obligations? They don't have to give a price. If the going gets tough, they just pull all their bids and there's nothing left there. Right. And I mean, that's really, the issue is that you don't have those affirmative obligations anymore, and you have these vacuums of liquidity where there's just no bids in the market. So what are your thoughts there as, comparing the system we used to have with the system we have today?
Well, there is still an obligation on the floor for the DMMs to effectively be 10% of trading volume. However, they're paid 3 cents a hundred to do that. So it's my theory. I can't prove it, but that is what causes the bursts at the open. So they want to get their 10% out of the way because they don't know what's going to happen the rest of the day. So you get paid for your 10%, and now your obligation is done. If something goes wrong, you can pull your quotes. So I just think it's important for traders to understand that it's a fragile market, that there's an awful lot of demand that comes from people who don't want to own things. And if you don't know that, you will have an unrealistic expectation of what might occur, just as it is with DWAC. So the reason DWAC is a meme stock, it happened for the very same reasons that GameStop and AMC theaters and so on went up 1,000%. It's because Citadel and various other market makers, it's not their fault. I've been into these Twitter exchanges with folks who believe that Citadel is nefarious. Well, Citadel is a major force in the markets, and it's after its own self-interest, but it's merely following the rules. And the rules say that if you're making a market in a stock, then you have an obligation to be at the bid and the offer for orders of 100 shares or less. Well, if they keep going up, Citadel is going to manufacture stock until all of those orders are filled and there's a nexus, at which point they will stop doing it and the stock will go down. And that's what occurs. So traders, you have to be aware of this, that it's not limited. The prices are not limited to the supply of the stock available. There are only 42 million shares of DWAC, including the warrants. And yet somehow it traded 430 million shares.
10 times.
Right. Part of that is market making, trading the same shares 10 times before you even have a chance. That's part of it. But the big part of it is there will be stock manufactured to fill a trade. That's the way the market works. How is that possible? Because the SEC said, thou shalt make a continuous auction, market makers. And they said, we can't do that. It's impossible unless we're exempted from the requirement that we locate shares to short. And the SEC said, fine. We've talked about this repeatedly before. They are exempt from Reg SHO Rule 203B2, and they can create stock. So realize that, traders. You got to be. That's why I say supply and demand matter. If you know we're going to see it on Market Structure Edge, we will know when stock is being manufactured to support prices because it's measurable. So you want to be informed and not the sucker. You go read that GameStop memo from the SEC. We talked about it a little bit last week. Spencer, you and I did.
Yep.
So the SEC pointed this out. They said, look, you have to understand market structure. How does the market work? And if you don't understand it, it's your own fault. Effectively, that memo says we're not at fault because these rules are necessary to support the market we have. Look, it's a marvel of technology. It's an extraordinary thing that we can support over $50 trillion of market cap with this system. But it's also very fragile. At any moment, quotes can crumble and vanish. And so you have to be aware of that.
Yeah, the takeaway seems to be you can hate the players, but in Tim's view, hate the game more. If you're gonna hate someone, hate the players, but hate the game more, because that seems to be where the and this is not the only area where this is a problem. Right? You can copy the same exact argument over to the what the Fed was doing with regards to trading individual stocks and well, we didn't break the rules. Well, that's the point. You didn't break the rules. That's the problem.
Exactly.
Yeah.
Yep.
So
and we could look at this in Funware. I mean, you can absolutely see what happened.
We'll jump into some of that stuff if you can. Just jump into the markets.
Show us what you got.
And we'll look at something that maybe you should own. I'm not saying that you should, but it's fascinating to see, where does money go if the market stops rising. By the way, statistically, and I'm going to share my screen here. Statistically, we measure supply and demand on a 10-point scale. And so I was looking at this data over the weekend, and statistically, year to date in 2021, the market has produced 0.0% returns at levels above 5.8. Guess where it is? 6.3. Meaning that if you take the times that it's above 5.8 and aggregate them in 2021, the return is 0. All the returns lie between 4, because it's not been below 4 in 2021 yet, and 5.8. Well,
so you don't want to be buying the market when it's 6.3.
Exactly. You shouldn't be buying the market. So what should you buy? Well, you should buy the stuff where all the low volatility money is going to go if the market starts to crumble. Where will it go? Well, that's measurable, and I'll show you. But here, let's look at Funware, just for the
for fun.
Yeah, for fun.
Just for fun.
Lots of puns today.
So here's the massive surge in fun, right? So it just exploded. Here below is short volume. That's the percentage of trading volume coming from borrowed stock. Well, people already knew right at options expirations that there was a high probability that this would occur. Now, how would they know that? I mean, who's they to begin with? And how would they know that? So see where my cursor is. This is short volume. That dotted line is the trend line for short volume. It is now over 50%. Over 50% of trading volume in Funware is coming from manufactured stock. I mean, no holder has to buy or sell for the stock to go up 500%. Because market makers will merely manufacture it and trade it at higher prices. So somewhere around options expirations, the machines who are making markets in options and the stock knew. Now, what did they know at that point? Well, maybe people started betting on options. And so these machines have the same kind of we run great algorithms. We have a pretty good idea where stuff's going to go in 5-day increments. And so those algorithms told Citadel et al. That we want to manufacture some stock And then we want to be long right here, right at the end of options expirations. So the 21st was the first day clear of options expirations. And wham, the stock explodes. Well, new options traded last week, be on the 20th, I think. So how is that possible? Well, they're market makers. They consume the order flow from options and from retail shops. They're going to know, wow, there's a lot of limit orders coming out of Robinhood and out of Ameritrade and out of Schwab. Okay, this thing could pop. All right, well, let's make sure we're on the right side of that trade because we're proprietary market makers. We're not serving customers. We buy order flow and then it becomes ours and we can do something with it. That is measurable. We could go look for that kind of feature in the marketplace. I could show you another one where that condition sort of exists. But that's what happens. So traders, you have to be aware that that condition exists. And when it's a rocket sled like that, when price is zooming and sentiment is already peaked, sentiment was already peaked the day before. The supply-demand balance had already been hit, so it's going to drop. You got to know that. If it had hit the ceiling, hit 10 and continued going, like Tesla, then you're okay. If you look at Tesla, here's Tesla, 10 and topped, and it's only 40% short. There is no excess supply of Tesla in the market. Look at that. In fact, everybody had to cover, and it's still a 10. Can that price go higher? Yes, it can, because there's still a supply-demand imbalance.
When do you sell? When they're sitting up at the 10s? Do you sell your peanuts when the circus is in town? Just get out because you don't know when it's going to end? Or do you ride it? When do you, and this is a question for me, and I've struggled with this for 22 years. I've been great on entries, and I've always kind of stunk at the exits. I always get out too soon. When is the best time to sell?
So I prefer to sell when I've achieved my return, right? And B, when the supply-demand balance changes. So if short volume begins to rise, then get out. Maybe we should look at SHOP. So I sold SHOP on Thursday. So I bought it on Tuesday and I sold it on Thursday. I bought it at 14.46. I sold it at 14.98. Now why? Because I could see this. It has a very short run. When it gets to 10 in SHOP, you should be out. Statistically, it will not continue to produce returns as it sits at 10. Why is that? I think it's because it's very risky to make a market in a stock that is trading at $1,400. So that was that's how I think about it, Dennis. By the way, you should also think about intraday volatility. So SHOP is 3% volatile every day. Do the math on that. That's a movement of $45. You got to know that if it moves more than that, you're now outside the intraday volatility and the market making is going to break down. I think about that stuff. I mean, I'm all about the math of the marketplace and taking your gains, not risk, right? Take gains, not chances.
That's it.
Yep.
Tim Quast joins us every Monday. He is the founder of Market Structure Edge.
Good to see you guys.
MarketStructureEdge.com. Tim, have a good one.
You too. See ya.